It is a pleasure to introduce our next instructor based in New York. Edward Chang is the founder and portfolio manager at Pledge Capital. He's a graduate of NYU's Stern School of Business with a bachelor's degree in finance and accounting. He also completed a master's degree in accounting during the same time. Before founding Pledge Capital in 2016, Edward worked on the sell side at UBS Equity Research, covering consumer retail companies. He had previous work experience covering a wide breadth of companies on the buy side as well. He's also a CPA. On behalf of the MOI Global membership community, a very warm welcome to you, Edward. Please go ahead.
Thanks, John. Very excited to join your Best Ideas 2019 and talk a little bit about the Joint Corp, a company that I believe has punch card potential. Just want to talk about some of the reasons I think, I feel so strongly about this investment, and of course, providing the information and leaving it up to the audience to decide whether or not it is a punch card stock. In all the time that I've spent learning about franchise businesses, the Joint Corp, it stands out. I believe it's truly exceptional. For one of its important characteristics, it's a low-cost operator in a highly fragmented industry. I believe it's going to take a lot of market share. It's levered to medical cost inflation. So it's not only is it a franchise, but I think there's a ton of pricing power as you just see costs for chiropractic care and costs across the medical industry rise. Third key characteristic, it's in the process of pivoting toward a regional developer model. Very similar. It's basically the same thing as a master franchise model. And, I think this is a game changer for unit growth. Lastly, I just would want to highlight that it is considered one of the top franchise opportunities out there by a lot of industry publications such as Franchise Times. So, a lot of very strong characteristics that I'm going to go through in this presentation. So let's hop right into it. So this is some of my contact information if people want to reach out. Definitely very open to feedback, opposing opinions, anything, to, get a debate going. So the bull thesis, it's really that the Joint is positioned to deliver very strong profit growth. So before I mentioned that the Joint is a low-cost operator, I think in many ways it's similar to Planet Fitness. The Joint's average fee for a chiropractic visit is $26, and this is substantially less than the $77 that other chiropractors charge. If we take out the reimbursement, the insurance reimbursement, because a lot of chiropractors take insurance, the out-of-pocket expense that consumers and patients pay at other chiropractors is still substantially greater than the $26 fee. And this $26 fee at the Joint could actually be driven lower using a lot of their wellness plans. So in fact, a lot of their patients actually pay less than $20. So there's this wide discrepancy is one of the reasons I think the Joint has been taking market share. One of the signs, it's grown same-store sales 20% 3 years in a row. I find that truly exceptional. Very, very rare to see a franchise business report that kind of performance 3 years in a row. And part of the reason is they've held their rates steady as the rest of their competitors have increased their fees. If you look at the bottom right, $63 in 2016, 68 in 17, and 77 in 2018. This is a study, a survey conducted by Chiropractic Economics. So, given this competitive advantage, I see the Joint taking considerable market share, and I think there's considerable room for them to do so. There's 60,000 chiropractors in the country. The Joint employs a little over 1,000 of them. They have 400 some odd locations. There's over 39,000 chiropractic offices around the country, and I think going forward, you're going to see more and more Joint chiropractic clinics open up, and as a result, they're going to gain market share. So I mentioned earlier that the Joint is considered one of the best franchise opportunities out there. It's ranked number 9 by Franchise Times. This puts it in the same category as concepts such as Planet Fitness and Wingstop, two other high growth franchise businesses with very high valuations. And, in my opinion, the Joint is actually in the same league, if not in a higher league. It's extremely, in my opinion, it costs a lot less. It costs a lot less to open one of these locations. The investment cost is less. Around $250,000, and for example, a lot of the franchise opportunities out there, such as Planet Fitness, will cost $2 million plus. Like Planet Fitness, I believe the Joint is relatively easy to manage. It's not like a restaurant where there's a ton of employees, there's inventory, there's very complicated, potentially very complicated menus to keep track of. The Joint is capital light, unlike an opportunity like Planet Fitness, which requires heavy investments in fitness equipment every 5, 6, 7 years. Like Planet Fitness and unlike other chains, this is the clinics have high incremental margins, and most importantly, investors in this who build out one of these clinics, they get exposure to medical cost inflation, and they're a low cost operator in their industry. So they have a competitive advantage, and the ROIs on new units are very attractive and should help attract franchisees into the system. The cohorts opened most recently in 2017 are reporting 50% plus ROIs, getting to that point in as little as 18 months, which is, compared to a lot of franchise opportunities, this is extremely, extremely attractive. And in my opinion, there's substantial room for ROIs to improve further. One of the reasons is clinics have extremely high incremental margins. Again, very few employees, no food costs. In the first 3 quarters of 2018, the company-operated segment reported 90% incremental margins. Now you have to take out advertising, which is actually reported elsewhere. So I think you can kind of ballpark incremental margins at say 70%, which is very, very high in my opinion. As same-store sales improve, you'll see ROIs go up. One recent change that I think is underappreciated by the market is the pivot to a regional developer model, aka the master franchise model. Now, um, this model has been used successfully by other franchise systems. Restaurant Brands International is one big example that use the model to help accelerate unit growth. So kind of stepping back, the challenge with a lot of franchise systems is to manage locations that are geographically spread out, right? And by going to a franchise model or a master franchise model, aka regional RD model, you bring in talent that otherwise would not have been able to attract just paying a salary. By giving small businessmen, small business owners an incentive, the proper incentives, you enhance and you promote the health of your brand. These people are incentivized to, manage locations more effectively. They're going to look out for solutions, look for ways to improve operations and the brand. And as a result, you enhance the competitive advantage of the overall chain by making such a pivot. And so in the last 2 years, you've seen the joint go from 8 regional developers to 20. And some of this was what I talked about earlier. I think you've seen talent come in to the system that is highly incentivized to help them manage franchisees in their area, enhance the brand, and recruit new franchisees into the system. And we're already beginning to see positive signs of this pivot. In the first 3 quarters of 2018, we've seen 60 new licenses signed to develop a new franchise locations. This is 60% greater than all the licenses signed in 2017. And I think there's substantial room, substantial upside for new licenses to be signed, for unit growth to accelerate further. With 423 units, there's substantial room before we hit the 1,700 unit potential that management estimates. And we're seeing improving ROIs, this pivot to working with RDs. So I'm extremely bullish on unit growth. And as a frame of reference, HealthSource, which is the joint's largest competitor, aims to triple units in the next 5 years. Again, that's not a goal necessarily for the joint, but it's a number, potential upside that we could see. So far, we've been seeing unit growth accelerate from a high single-digit percentage to a low double-digit percentage in 2018. Now, these are kind of the numbers that I'm working with in my model. I consider them conservative. 13% growth in 2019, which is up from 11%. That represents 60 total unit openings. We've seen 60 licenses signed so far in 2018. We could see another 20 signed. So they're reporting in the next month or so, and we could see another 20 units licenses signed in to complete the year, bringing the total to say 80. So I don't think that's out of the realm of possibility. You have 20 RDs out there marketing this franchise, one of the top 10 franchises with a very attractive ROI, relatively easy to manage, a low, total cost to invest, $250,000. It's the low cost operator. in my opinion, I would be able to sell this if I was an RD. I would be able to sell this. I would be able to get more than 3 licenses a year. I don't think it wouldn't be unreasonable to expect an RD to get 4 or 5 on average per year. Not to mention the corporate entities also out there trying to sell additional locations too. So I think there's a tremendous upside to unit growth. I mean, we could end up seeing mid-teens, high teens, even 20% growth if at some point in the future. So on one hand, the chain can take share by opening up new units and employing more chiropractors. On the other hand, sales growth could be driven by increasing prices. I believe this chain has tremendous pricing power that is underappreciated. Healthcare inflation, amongst a lot of the industries in our economy, it has experienced one of the highest rates of inflation. It's up there with education. And, within healthcare, chiropractic is no different. In 2017, the average chiropractor increased fees 8%. In 2018, we're seeing 13% fee growth. And, in this kind of environment, the Joint has actually put off on price increases and held their fees steady for the last couple of years. I think this is a very smart business move. Trading profitability for goodwill is one of the reasons their system sales are growing so quickly. They're delivering chiropractic care at a substantially lower price. And in my opinion, the company could raise prices in 2019 or 2020 quite substantially without any negative repercussions. They could continue gaining market share from the rest of the industry. So again, I mentioned earlier the high incremental margins. By my estimate, a hypothetical 10% increase in same-store sales would drive new unit ROIs for the 2017 cohort from the mid-50s to the high 60s. That would put the ROIs at one of the highest among franchise opportunities out there. Something like McDonald's or Burger King would be around 15 to 20 as a frame of reference. So is Joint a punch card? We've talked about a lot of the good. Well, what about the bad? So what are some potential risk scenarios? Franchisees could terminate or refuse to renew their agreements and go independent. Other chiropractors could copy the Joint's model, low-cost model. You could see changes made to insurance coverage and plans and have an adverse impact. Good for people, but potentially bad for the Joint. It would advantage, company chiropractors that do take insurance. Single payer is a risk. And of course, I'm just throwing in a weak economy just because. All right, so how likely are franchisees to go independent? Franchisees sign a 10-year agreement, and this includes a non-compete clause. They're not allowed to operate a chiropractic clinic within 25 miles or 24 years after a agreement lapses or gets terminated. Judges in most states will grant injunctions when non-compete clauses are reasonable. And they're considered unreasonable if it's geographically too broad or for a ridiculous length of time. So I think 25 miles and 24 months falls within this reasonability. And of course, none of this is legal advice. So this is the actual non-compete clause from the franchise disclosure document. And I mentioned the injunctions before. The injunctions for the non-compete clause don't always get given. A notable exception is a state such as California. And in those states, you have to depend on other, for example, a trade secret. And the joint's wellness plan is structured in a way that I believe this provides another layer of protection for the parent company, the franchisor. So 76% of the joint's system sales actually come from wellness plans. This is it's almost like a membership where you can visit any location up to 4 times a month. And because so technically all this money and this membership, it's with the system, not with the individual store. So the company, the franchisor, gets control of the prepaid monthly fees, and then they dole it out to the individual locations. So this is this client list is one potential protection. The fact that individual locations depend on the parent company and this wellness plan for the vast majority of their sales. It's just an additional layer of protection to prevent franchisees from leaving and going independent. Again, none of this is legal advice. So why won't other clinics copy their direct payer model, right? And why won't this create a problem for the joint? So I actually think other chiropractors will. I think the direct payer model where they don't take insurance, where they only take cash or credit, it's a superior business model for pretty much everyone involved. And we are seeing a tick up. We have seen a tick up in the amount of cash or direct payer chiropractors. It's increased from 10 to 12%. So 88% of the industry still takes insurance and doesn't run a cash only business. So I absolutely think this will happen. Direct payer business model has less paperwork. Chiropractors have more capacity to see patients. I mean, if you talk to any doctor, they complain about how much time they spend doing paperwork, how hard it is to figure out all the different insurance policies, how to bill properly, and how to get paid on time or even get paid at all. Doctors in general just don't like working with insurance. So not only do doctors get to avoid this headache, reduce the overhead of their clinics, because they can spend more time now working with patients, which is, I think, in my opinion, largely why a lot of chiropractors got into this business, to help patients with pain. But ultimately, I see chiropractors who don't take insurance. I believe they will see more patients. They have the capacity to see more patients, and we can't extrapolate 20% like traffic growth, but over time, if it keeps occurring, chains like the Joint or chiropractors that don't take insurance should see more patients, gain more experience. Franchise chains like the Joint, a lot of them share best practices. This will all help them deliver better patient outcomes long term. So I absolutely believe that the third-party payer model will lose market share to direct payers. And I don't see this as an issue. McDonald's competes with Burger King, Wendy's, In-N-Out, Five Guys, a ton of other, burger concepts. There's 60,000 chiropractors in the United States. The Joint only employs a little over 1,000 of them. I think there's room for a ton of different players. Um, for restaurants, 50% of restaurants are independent, 50% are chains. The percentage for the chiropractic industry is significantly lower. I mean, why can't I believe the joint can get to 6,000 chiropractors eventually. I don't think that's out of the realm of possibility. So another risk is potential changes in insurance coverage. Um, just in general, we're seeing higher deductibles across the board, not just a larger percentage of high deductible health plans, but for example, according to Health Equity, HMOs, PPOs, POS plans are all seeing extremely high growth. Deductibles have gone up a high single digit percentage long term. And higher deductibles favor a shop such as Joint. And so this is obviously a very, very difficult to read, but this is a sample of different insurance plans by Fidelis, and different premiums, different deductibles. Here, let's go to the next screen and kind of summarize. In every single case, all these different plans, from catastrophic plan to the platinum plan, every single plan, it's more expensive to use insurance to go to a chiropractor than to just visit the joint directly and pay out of pocket. And I've found this reviewing a lot of different insurance plans. I've found this to be the case the vast majority of the time. You save money. Patients, consumers save money by going to the joint. Their prices are so much lower that even in many cases, the best plan, the copay is still more than the average fee, the $26 average fee at the joint. And I mentioned earlier the wellness plans actually drive the average fee further down. So a lot of patients of chiropractic services, they are going regularly, not just like one-off visits. They could be visiting every week. I spoke to someone who was pregnant, and gave birth and was visiting more than once a week, right? So for them, instead of paying $77, right, and paying the copay, potentially paying the full amount of the 77 because they haven't reached their deductible for the year, it makes a lot of sense for them to get a wellness plan, a $60, $70, $80 wellness plan, and just go to the joint instead. But I do have to mention that although deductibles are going up across the board, you are seeing kind of a drop in high deductible only plans being offered by large employers. What I mean is a high deductible health plan is the only choice, and that fell recently from 39 to 30%. So that should kick in 2019. Now, not everyone, despite being given more choice, not everyone's going to choose another plan. High deductible plans are, I actually think makes sense for a lot of young people, especially when you pair it with a direct primary care plan. Don't want to get into that too much, but there's primary care doctors who are offering memberships where they cover a lot of the basic necessities. So for $100 a month, and if you throw in a catastrophic high deductible plan, a young person, in their 20s and 30s, it actually makes a lot of sense to pay for that kind of insurance as opposed to a more expensive six, seven, $800 health insurance plan. And again, just kind of frame this, large employers are they don't employ everyone. Small businesses are just as important employer for in our country. Um, and again, all insurance plans are seeing deductibles increase, and the joint is just more affordable than almost every single insurance plan out there. So, another risk is a transition to a single payer model, right? And of course, that doesn't seem very likely when the Republicans control the executive branch and the Senate. Kind of hard to see that happen in the next 2 years, but could it happen down the line? Possibly, something to keep in mind as a potential risk factor. And lastly, recession risk. This is one of the reasons I find the joint so compelling at this particular moment, given macroeconomic uncertainties. It's a healthcare company. It's a low-cost business. It helps people deal with pain, right? 76% of their sales come from monthly wellness plans. I believe this business exhibits much lower risk than most other industries. I would rank it down with telecom, right? Consumer staple stocks. And more importantly, it's a secular grower. It's growing units 12, 13% percentage points a year, perhaps higher. It's exposed to medical cost inflation. I believe they have a solid pricing power going forward. I think there's a very good visibility into same-store sales increases. So, overall, these are just kind of the risk factors that I thought were important to highlight. The good and the bad things to consider. So, let's move on to the last section, which is valuation and estimates. And before I get into that, this is a cool quote that I found. I think it really franchise businesses really fit this description. Having covered and studied a ton of these businesses, I personally love the model. It's definitely gone some flack in the last year or two from some very notable short sellers, but it's still a business that I think is very well set up for growth, assuming you got the client experience right. You're delivering value, right? This business, in my opinion, is incredible. Very little maintenance capex, very high free cash flow generative, can support a lot of debt. I think it's very, very defensible. It's a big improvement, in my opinion, versus a lot of the company operated chains, which tend to get into a lot of trouble. Very hard to manage. It's very hard to attract the right kind of talent. So, anyway, we can get into that more in the future. Okay, so this is kind of to summarize a lot of the reasons I like the joint, and I think it deserves a very high valuation. 90% plus it's a 90% franchise business, low cost operator, exposed to healthcare inflation. Repeating a lot of the same things. So I'll just move on to the next slide. The joint, relative to a lot of the franchise chains that I follow, such as Planet Fitness and Domino's, it delivers extremely strong results. 45% CAGR for system sales the last 5 years. Last 3 years, it's slowed down to 30%, which still extremely rare. And I believe that puts Joint in the same league as Planet Fitness and Domino's, which are very good concepts, but the Joint is way earlier in its growth story. So delivering much better results. The Joint sells at a substantial discount to Planet Fitness and Domino's on a price to free cash flow over the next 4 quarters, and also price to EPS over the next 4 quarters. I think there's upside from a valuation standpoint, and the Joint, in my opinion, has much better long-term EPS growth potential, 35% versus 15 to 28 for these other concepts. And I know there's not a lot of estimates out there, but these are mine. I've tried to be conservative with my projections. I think there's a lot of upside for unit growth, and I haven't factored that fully in. I'm assuming relatively conservative incremental margin and flow through, in the 50-60% range, 60 probably for the next year or two, and then kind of drops down to 50 longer term. But I still get to 40 cents in free cash flow in 2019, heading to over $1 in 2022. So with that, I like to if there are any questions, that's the end of my pitch.
Well, Edward, thank you so much for that very interesting presentation. Maybe I'll just start with the length of the growth runway here. Is the best way to think about this the fact that they've got about 1,000 chiropractors out of the total number of, was it 60-some thousand?
Right. Yeah, that's definitely one way to triangulate it. Another one is to look at the fact that they have 400 some units, and they think they can get to 1,700 longer term. And they've talked about hiring additional chiropractors for their clinics, maybe adding another one. So they could support 2, 3, 4 chiropractors in different, depending on the location. So if you think about 1,700, kind of gives you a sense of, I think, where they're thinking long term, getting to maybe 6,000-7,000 chiropractors. So kind of like what they think of their share of the total chiropractors out in the United States. But there's no perfect way to think about it. I do think it's very early stages, though.
And with the franchise model, the chiropractor in a way is also a business person. How do you think about their qualifications there? I mean, is there much skill required on the business side, or not really?
Well, I think the benefit of a franchise system is that they provide a ton of training, and they really enhance your ability to succeed as on the business side. I think it's one of the big reasons, going with established brand, having a business model that works, been proven to work. So your chances of success are much higher. So for a lot of restaurants that open independently, there's a very high failure rate. And the failure rate is significantly lower for franchise businesses. So on one hand, chiropractors, I understand they have a specialty. They went to school for chiropractic care, not necessarily business people. But the ones who do want to work with Joint, I think they're their chances of success are higher. I think they should make more money opening up a joint versus an independent clinic, dealing with insurance, dealing with all the other challenges of being a business owner. Um, they, the regional developers, for example, the other franchisees in the system, they all provide support. Especially the regional developers, they're incentivized to actually coach and make sure the chiropractors who do want to open up a clinic succeed. If the clinic does well, then the regional developer makes more money, right? And this is a very interesting topic, because I don't think that the business people who invest in a joint are necessarily um, limited to just chiropractors. I think you're seeing a lot of individuals who have no chiropractic experience, who chiropractors are not necessarily the most business-minded people, right? So they're not necessarily the most entrepreneur. They might just want to collect a paycheck. So they're working with business owners who do want to take the risk, who are attracted by the ROI and don't mind the risk of starting their own business, who are actually funding the capital and employing additional chiropractors within the joint system.
I think you mentioned there are short sellers as well here. Just wondering whether you are familiar with what their thesis is.
So I'm not familiar with any short sellers in this particular stock. I was simply speaking more broadly, talking about some of the issues that franchise businesses are not perfect. They do have their flaws, like any business model. You can definitely kind of get a lot of it, in my opinion, is communication, poor communication and poor teamwork. People, franchisees not working well with corporations, especially when their incentives are aligned. So, for example, with Wingstop, prices of chicken wings are falling. So the gross margin for franchisees are expanding, and they're incentivized to actually drop prices and get more volume. They're looking at the gross profit dollar per order, whereas the franchisor is more concerned with total sales, right? And I don't think that's a problem for a franchise business such as the joint. There's very strong medical cost inflation. The rest of the chiropractors in their industry are raising prices, and that kind of gives the joint air cover to raise its prices too. And so raising prices for its wellness plans is not only good for its its franchisees, it's also good for the franchisor as well. So I actually think that this franchise concept, you have a lot more alignment of franchise corporate interests, and some of the reasons that people are negative on other franchise concepts, I don't necessarily think those are issues or problems here for the joint.
Could you shed some light on a little bit of the history here? I'm looking at the stock chart, and it looks like from mid 2015 to mid 2016, the stock had a big drop, and previously it had reached a high of more than $10 a share.
I think a lot of new concepts, they get into trouble from it, from a few different, there's definitely issues with valuation. There's also issues with growing at a sustainable pace. Um, Growing really fast is very, very difficult. Finding the right franchisees, finding the right partners, right? Um, there's a problem with quality. You can't just give anyone with $25,000, $250,000, the opportunity to start one of your clinics. You could run into troubles. I think that happens quite frequently. A lot of I'm talking more generally here. A lot of concepts in the beginning when they are opening up, they go with more of a company operated model. And the bigger those company operated systems become, the more likely it'll run into management issues. Now, some chains are able to avoid that. It takes a lot of managerial, you know, skill to execute that kind of system well. It's simply much easier to go with a franchise model. And if you layer in the regional developers, which is what the joint has been doing, you can kind of eliminate a little bit more risk. Again, it's not perfect. Regional developers, are not perfect either. Everyone's a human being, so you can always have a bunch of different issues crop up. So I think it was a combination of valuation, operational difficulties. They really had to slow growth down. The stock was very, very far away from profitability. It was the company was losing a lot of money, during at the last peak, and compared to then versus now, I think the stock is already solidly free cash flow positive. In the last 4 quarters, they generated 20 cents a share in free cash flow, and I think that's heading to 40 cents plus in 2019. And I think they are right now really well set up to avoid a lot of the issues that they have experienced in the past and other franchise chains have experienced in the past that lead to create potential risks and problems down the line.
Well, Edward, I'm going to leave it there. I'll just encourage our members to follow up with you directly with their own thoughts or questions. Thanks for showing your contact information there earlier in the presentation.
Yeah,
truly
sure.
appreciate you being here and sharing this idea with our community.
Yeah, no, thank you so much for having me. It was my pleasure. And yeah, if anyone wants to reach out, my email is edward.chang@pledge.capital, or you can find me on Twitter at Edward W. Chang. John, once again, thank you so much.
Thank you. Goodbye for now.
Okay, bye-bye.